I believe the next 3.5 years are going to be a bonanza if you own the right stocks. But you've got to own the right stocks. And what I want from what I call the right stocks is an annualized return of 33% over the next 3.5 years. That would take me to January the 1st, 2028. So what I have to do is find companies that are going to give me my objective of 33% annualized return each year. How do you determine that? Well, you find out the price of a stock is made up of two things. It is, one, its earnings per share multiplied times its PE ratio. Well, the CEOs and the analysts tell us what companies are projecting their earnings per share is or is going to be over the coming years. So the only variable we've got to figure out is that PE ratio. Well, how do you figure out what a PE ratio is going to be? Well, it's kind of the same way you figure out a guy's batting average. You look at his past history and see what he's been able to achieve. So what I've done is I've gone through the 40 stocks that I want to own, and I'm creating an algorithm that says, okay, based on since 2009, or since they went public since 2009, what has been their PE ratio, and how has it progressed as the company has progressed, and what is my best calculation of what the PE ratio is going to be over the next 3.5 years. Well, what controls the PE ratio? It basically is based on what the growth potential of the stock is in the mind of the market. So I look at what the mind of the market is in my category, my sector, and my sector is AI and semiconductors, and the related stocks in that field. And then I attach the historical best estimate PE ratio, multiply it times their earnings, and I can predict, I believe, with some accuracy, are they going to meet my objective of 33% per year annualized return over the next 3.5 years or not? And so then I decide whether I want to buy them. So to show you this, I want to show you what my projection of the price of Palantir and Tesla are going to be over the next 3.5 years, so that I can make a decision, do I want to own them or don't I? Because truly, I can find enough that are going to give me that if I do the research. Let me take you to my computer, and I'll walk you through Tesla and Palantir's projected earnings for the next 3.5 years. Okay, here's the spreadsheet I've created to analyze both Palantir and Tesla. Again, my objective is to achieve an annualized return of 33%. So I have to determine what is the end goal. What does that look like? So I created a hypothetical portfolio of $10,000. I said that I'm going to make 33% the first year. That's going to add to it $3,300. And so my portfolio grows to 13.3. That 13.3 then grows by 33% to 17,689, and at the end of the 3.5 years, my portfolio grows to $27,290.59. Well, that's an overall growth from $10,000 to $27,290 of 173%. So that's the objective, okay? So now let's go up here and look at Palantir. Palantir went public in 2018. I have a stock price on it starting in 2021 when it was selling for $18.21, and then it dropped to $6.42. At this point, its PE ratio, it is losing 27 cents a share. It is at a negative 67. And the next year, it makes 6 cents, so it has a PE ratio of 107. The next year, it makes 25 cents with a stock price of $17.17, so the PE ratio is 68.9. And then this year, it is selling at about $23.31, and its earnings per share are 33, so its PE ratio is 70. So what I do is take an average of these three. I throw this one out, and I have an average PE ratio of 82.1. I then take that 82.1, and multiply it times their projected earnings per share in 2025 of 40 cents. And that gives me a price on the stock of $32.84. I do the same thing the following 2 years when they say they're going to have earnings of 47 and 57 cents, and I come up with a price of 38.59 and 46.80. So that gives me, at the end of 2027, the beginning of 2028, that Palantir stock has gone from $23.31 to $46.80, and that's roughly a 100% return. Now, does that meet my objective? No. No, my objective is 173%. So that says Palantir isn't going to reach the objective that I have. But again, am I going to find stocks that do? Well, is Tesla one of them? I go through the same process. And again, I throw out their negative returns, their negative PE ratios. And then again, when they start up, and start making a profit, and you can see the stock is selling for $235. Look at this. When they IPO'd, they were $1.90. Yeah. So, but here in 2020, they're at $235 per share. They're making 25 cents. That gives them a PE ratio of 940. That's a little extreme. It then comes down that the next year, their earnings grow dramatically by 648% to $1.87. So that PE ratio becomes 134. The next year, they're making $4.07, and their PE ratio becomes 30, and then 79, and then 70 this year, based on a price of $178.70 and earnings of $2.55. Their current PE ratio is 70. So I give it an average of these of 78. I then say, based on what the analyst and Tesla is telling me, that their earnings are going to be $3.52 in 2025, and at a PE ratio of 78.7, their price will be $276.87. I carry the same PE ratio forward on earnings of $4.54, and that gives me a price of $357.10. Again, their earnings go up another 20% to $5.43. Using, again, our historically average PE ratio, we have a price of $427.11. That gives me an overall growth rate of 139%. That's closer to the 173 that my minimum is, but it is not there. Would I own Tesla with that? Well, I would say that depends on if I can find some moonshot stocks that give me a healthier return. Certainly 139% is not something to sneeze at, but it is certainly better than the 100% that Palantir. So if I can only buy one of these, I buy Tesla. Okay, so that's how I go through this, and it's the same thing that baseball leagues do. They create a historical average. They project that forward, and they come up with a batting average. Now, are there stocks that will give me that 173? Well, let's just page up here and see. There's one, Ultra Clean, based on its historical average. And here the PE ratio is only 26, but you see, look at the growth of their earnings. I'll get 320% on that. So that's one of my moonshots. Although the company has been around since 2009, it gives me a history, and it gives me a growth factor of what their earnings are going to grow. That's what this number represents. I've taken from 2024 to 2027, and that's the growth that they're projecting. Compare that to Palantir and Tesla. No comparison. Now here's Dell. This was a surprise to me. I probably need to sell my Dell because based on what they're telling me, their earnings and their historical PE ratio, and please notice how low their PE ratio is compared to other companies. So Dell is probably something I need to get rid of. Here's Super Macro Computer. This has just blown the doors out in the past. But it's only going to give me a projected 54% return based on their projected earnings. And again, look at their earnings. They're projecting over 3.5 years or 4 years that their earnings are growing by 192%, where Ultra Clean is growing at 528%. Here's another one. This is Navitas. 628% projected growth, down, which means it's a depressed stock this year, which means its price is low at $6.54. But if it hits its numbers, it's going to be a $52 stock, and it's going to give me $1,050. This is what I do. This is how I project what stocks I want and what portion of their portfolio, of my portfolio, I want them in. This is what I put forward on my cheat sheet. I am altering the cheat sheet as we speak, and by this time next week, it will be updated to reflect this new algorithm that I'm creating to project what is a stock going to be worth on January the 1st, 2018. And do I want it in my portfolio at all, or do I want to allocate it accordingly to how close it comes to my objective of an overall return between now and January the 1st, 2028 of 173%. I hope this helps you. I hope you recognize that with data, and if you know where to go to get the data and how to analyze the data, creating this spreadsheet is something I learned, something I taught myself. And I want to teach you if you choose to do this. If, on the other hand, you want an inside connection to somebody who is doing it and you believe it holds merit, that it will work to help you make more money, to help make you a better investor, well, then get on the bus. And the bus is a joining of a community of like-minded people who are willing to learn and then take and share their learnings so that we can all benefit. We don't want to be a Goldman Sachs with 46,300 employees managing $1 trillion and making a few people just super dirty rich, while the others just scrape by. The other thing I want you to think about is, why would you invest in an S&P 500, where you're looking at 500 stocks? Some are good, some are bad, but you're just getting the average. You want to look for the Babe Ruths, the Mickey Mantles, and whoever the best hitter is today, and look at his history and then determine how you can put him on your team, how you can pick a Seth Curry and a LeBron James, how you can pick these people who will give you performance year after year after year. I'm Kerry Grinkmeyer. I'm a retired financial advisor, and I want to help you make better investment decisions, and I'm willing to work for you. Talk to you again tomorrow.